Thank you, Mr. Chairman, Ranking Member Lunder, members of the committee. My name is Doug Holmes, President of UWC. UWC is a member organization nationally that represents, there we go. UWC represents business in unemployment and workers' compensation issues. We're based in Washington, D.C. By most technical economic measures, the Great Recession of 2008-2009 is over. Initial unemployment claims are trending down, mass layoffs have been reduced, and there has been some employment growth in certain sectors of the economy. Yet, the total unemployment rate remains in the 9.7% range, and we are now faced with large deficits in the Federal Unemployment Trust Fund and many state unemployment trust fund accounts. The most effective way, quite frankly, to improve the solvency of unemployment trust funds is for employers to start hiring again. Increasing employment not only reduces benefit payout, but also increases tax revenue. Confidence among employers to hire workers is not yet where it needs to be. Employers are reticent to create new jobs or rehire employees in part because of the uncertainty and size of payroll tax burden. The National Federation of Independent Business has released the results of its Index of Small Business Optimism for the month of March, which showed increased weakness in comparison to February and still more firms planning to cut jobs than planning to add them. Immediate action is needed now to improve the outlook of employers making decisions about hiring. Providing relief from federal unemployment tax penalties would send a positive signal to business and provide needed tax relief. The waiver of interest on loans to states to pay unemployment compensation should be extended through 2012, helping states and employers in the short term to plan to restore solvency and implement solvency legislation within a reasonable time frame. Consistent with the continued waiver of Title 12 interest, federal unemployment tax offset credit penalties should be waived through 2011. This immediate relief should be the first step of a two-step strategy to first address the immediate need for measures to encourage job creation, and secondly, to develop a longer-term strategy to manage the tremendous debt in the unemployment insurance system that has accumulated. As of April 29, 2010, 35 states and jurisdictions had outstanding Title 12 debts totaling more than $41.1 billion. The balance of outstanding loans is projected to increase from $41.1 billion to a peak end-of-year balance of $93 billion in fiscal year 2013. A total of up to 40 states are projected to borrow. The federal unemployment account from which states borrow to pay unemployment compensation is itself in deficit and relying on transfers from federal general revenue to cover loan obligations. Some individual state unemployment benefit accounts are in even worse shape than the federal accounts. State UI tax revenue has been overwhelmed with increases in benefit payment. It is not possible for many states to increase state unemployment taxes or reduce benefits enough within the period before the next recession to reach current U.S. DOL solvency suggestions without unprecedented tax increases and/or slashes in benefit payments. Virtually no economists, state officials, legislators, or employers in 2007 anticipated the length and depth of this recession. Most states were prepared to meet the benefit payment requirements of a 2001-size recession, but not one with historical proportions. State UI tax increases resulted from increased benefit payments have begun. In 2010, state unemployment tax wage bases increased in 24 states. Contribution rate schedules are expected to increase in 28. The impact on state unemployment tax rates lags the increase in benefit payout by 1 to 3 years as the increase in benefit charges begin to factor into state unemployment tax rates. The bottom line for business is that state unemployment taxes, on average, are likely to more than double in the next 2 to 3 years. Turning to long-term solvency. As we address long-term solvency, we should recognize that the current and projected insolvency of federal and state unemployment trust funds is not just the result of the recent recession, but reflects long-term trends that must be addressed. The two primary factors in long-term insolvency are, one, the slowing rate of growth in the U.S. economy as measured by increases in employment and wages, and two, the trend over a number of decades in increasing duration of unemployment compensation. The GAO report released at this hearing identifies a number of factors to consider. Additional study is needed with respect to the impact of federally increased view-to-tax basis and the interplay between state unemployment tax rates, basis, and benefit provisions. One observation I would make in my initial scan of the GAO report is that we should be cognizant of the impact of individual states. There are some states, 12 states, with above-average tax bases that are borrowing now. There are also 3 states with below-average tax bases that are not borrowing. Clearly, the tax wage base is not the only factor to consider. Thank you very much for the opportunity to testify. I'll take any questions.